but you'll get this realization over time that inflation, stagflation is here to stay. Real interest rates, the Fed has to keep them negative. That's what they've done in the past with yield curve control. And gold will rally.
Welcome everyone to StockPulse's Inside the Markets. I'm your host, Justin O'Connell, and we are more than honored to be sitting down today with Craig Hemke, founder and publisher of TF Metals Report, which will be celebrating its 11th anniversary on November 11th. Congratulations, Craig, and thank you for joining us.
Year 11 on 11/11. How about that? Thank you, Justin. It's a pleasure to get a chance to meet you and be on this channel for the first time.
You are keeping an eye on inflation currently, and you think that there might be some change portended at the Federal Reserve. What are you looking at in terms of inflation, and what ramifications might that have at the Fed?
Well, I tell you what, my friend, it has been such an interesting couple of years, obviously with COVID, kind of really mucking up the water and all these lockdowns. And, at my site, we started talking back in June of 2020 about stagflation and how this was we're likely headed that way because, the Fed and all the other central banks, their only tool to try to keep things going was going to be easy monetary policy indefinitely. Powell has talked about no rate hikes till at least 2023 since 2020. So you knew you had that part of it going. We weren't really talking about supply chain disruptions as much as just the fact that, once businesses started working remotely, for example, and there was just no reason to keep as many employees or at least keep as many employees in an office as there had been before. And so eventually these ripple effects were going to go through, like the commercial mortgage area, where companies used to have 10,000 square feet and they find they can just get by just fine with now 5,000, that sort of thing. So we've been anticipating a stagflationary environment for about a year and a half. And with that, that would mean negative real or negative inflation adjusted interest rates. Well, real inflation or real interest rates are the strongest long-term correlation for gold prices that we have at about 95%. So all those dots seem to connect that we'd have higher gold prices. That took hold, obviously, in late last year. Then, man, we've been fighting this fight for better part of 12 months. Really, it was almost a year ago today as we record this that the Pfizer vaccine news was announced, and gold rolled over from about 1965 and hasn't been there since. And I think what has happened as I've observed all of this is that the market in general, and I use that kind of, this nebulous term of the market. And what I'm meaning is like hedge funds and institutions and the people that actually buy the gold futures, and you need buyers of gold futures to make the gold price go up, that they've kind of bought this whole inflation is transitory narrative, hook, line, and sinker. And they swallowed it, and they've watched real interest rates go sharper and sharper negative. And yet gold hasn't responded because, well, it's transitory, and Fed's going to drive nominal rates back higher and inflation is going to go away. So I'm not too worried about the negative. God, what is it? 6.2 on CPI today, and the 10-year notes at 1.5. So what's that, negative 4.7? Hey, I'm not worried about that because that's all going to change. Well, now we're getting this realization, maybe it ain't going to change. Right? Maybe the Fed is trapped. They can't let, rates ever normalize, but at the same time, this inflation's not going away. I've been writing for months that this market inefficiency in gold, Justin, and that's really what it is, that, real interest rates would be this sharply negative, but gold would still be at $1,800. That's a market inefficiency. And usually when markets discover inefficiencies, they correct gradually at first and then all at once, and then like in a big hurry. And with today's CPI report, as we record this on the 10th, I think we're starting to see some of that not so gradual move back up. So I'm optimistic, not like for all my friends and neighbors who are getting squeezed and pulled in so many different directions, but I'm optimistic that gold and the shares are going to kind of pick up here as we go into the end of the year.
Which shares in particular are you taking look into at this point?
Well, that's been an interesting little bit of conundrum here too, because with the GDX got to we use that, the GDX ETF as a kind of a proxy for the mining shares. A lot of people trade in and out of that thing, and it got to 46 last year, and geez, down to what, 29 or 30 couple of weeks ago, 30 some odd percent pullback. And one, that's extraordinarily frustrating, and the price of gold hasn't helped. But I think what I've come to figure out, and look, I'm not going to like take credit for this, like I figured this out on my own. On my TF Metals Report site, I had two different podcasts in the last 4 or 5 weeks, public podcasts. Anybody can go there and find these links, where one guest was Joe Mazumdar. And Joe is like a renowned, objective mining analyst, runs Exploration Insights. He took it over from Brent Cook a few years back, and everybody really respects what they do. But then I also spoke with David Garofalo, who now runs a company called Gold Royalty Corp. So he kind of likes the royalty idea, but he used to be the longtime CEO of Gold Corp. Okay, so he knows what he's talking about. And both David and Joe said, this is a time when there's a reason why the major miners have been going down. And that's because their margins are just getting compressed so severely. I mean, they're really in a tough spot, at least in terms of generating cash flow and, profitable profits and that sort of thing, because input costs if you're a major miner have been going up dramatically, just like input costs for every other company, right? Energy costs, you get supply chain disruptions, your mill gets shut down because you can't get a part. And then all of a sudden that part's sitting on a tanker out, off the coast of Long Beach. So you're getting pulled in that direction. Same time what you're selling your product for, because not a lot of miners, hedge like they did 20 years ago. What you're selling your product for is going down. I mean, so your margins are getting squeezed. And that's what's been impacting the major miners. So now look, if I'm right about price of gold starting to rally and silver starting to rally and come out of this consolidation phase, well, then we're at least going to get some ease of that. And we've seen the GDX pick up. Now, GDX, as we speak, gapped above its 200-day moving average today. It gapped up its prior high from a couple of weeks ago. Whether it can hold it all the way into the close because the metals have been kind of washed back a little bit over the last few hours, we'll see. But the shares are picking up, and there's reason for that. But in the meantime, God, this is a long answer, Justin. I apologize. In the meantime, I'll go with what both Joe and David said. And that was, in an environment like this, you're actually better served with royalty companies than producers. Because the royalty companies just have this, stream of income that's coming in instead, and they're a little less impacted by all these margin pressures and falling costs. And so you see things like Franco-Nevada continue to do great, haven't nearly pulled back as much as, a Newmont or a Barrick or something like that. So royalty companies and even exploration companies maybe are another way to go too, because again, they're not pulling anything out of the ground yet, So maybe they're a better way to go. The GDXJ has performed better than the GDX as of late. So maybe that's evidence of that. So until we get a sustained breakout and get rallying again in price, maybe that's still the way to go in terms of how you allocate in the sector.
You believe that Jerome Powell is on the cusp of being replaced. Why and with whom?
Oh, dude, man, I tell you, this is fun, Justin. You okay with that last long answer? Can I keep on going here?
Please.
See, if you haven't noticed already, you mentioned 11 years worth of TF Metals Report. I do a podcast every single day that's unscripted. So, everybody at my site gets like a 20-minute daily podcast where I just talk. So I apologize. You get me started sometimes, and I'll just get going. All right. So this is something. Man, you want to talk about a hanging curveball that may be sitting out there for gold and silver as we get into the end of the year. Let me lay this on you. First, politically, we know that Biden is struggling to try to appease all of the heavy left-wing progressives in his party. I mean, Pelosi is as well. They're all screaming they want $4 trillion in spending, not just 1.2, right? But so Biden wants to do it, and obviously they want to spend more. But here's Powell, Trump appointed, by the way, old white guy, right? Not a diversity hire, who is now pledging to cut back what the Fed is doing. There's this woman who's a Fed governor named Lael Brainerd, who's a favorite of the AOC crowd and of the progressives. She's kind of more in this uber dovish modern monetary theory thing. You know, maybe that $1 trillion coin kind of stuff isn't such a bad idea. So she's a real big favorite of them. All right, so now let's run the clock back to, as we speak, a week ago today, Tuesday the 3rd. Biden's over there at that global warming summit in Scotland. He's getting ready to leave town and he has a press conference. And he was asked in the press conference, hey, look, man, hey, it's now 2.5 months until Powell's term ends and you haven't renominated him. This is the longest any president has ever gone. They're late in the game anybody's ever gone without renominating. What are you going to do? And right then, Biden could have said, oh, you know, Jerry's my guy, you know, an old white guy like me, we're good. But he didn't. He kind of shuffled his papers and hemmed and hawed and all that kind of stuff, said, still thinking about it, and I'll have an answer for you soon. Well, wait a second, what do you have to think about? Okay, so now follow along with me, Justin. Biden gets back on a plane that night. I remember him saying in the press conference, he was scheduled to land at like 1 a.m. Washington time. Well, geez, for you and I coming back from Europe, you need a day to recover. I can only imagine if you're 78. So Wednesday is his day to kind of, you know, sleep through the job and let everything just go. Well, Thursday is his first day back in the office. And headlines hit on Thursday that not only was Powell at the White House, Lael Brainerd was at the White House together at the same time, maybe crossing paths, something like that. So did Biden come back, decide against Powell, tell Powell he's not going to be renominated until Brainerd, you know, and reports have since come out this week, back on Monday, that it was actually considered a job interview for Brainerd. How the markets responded since then. Now, today notwithstanding, because of the CPI data, but between Thursday of last week and yesterday, Tuesday the 9th, the yield of the 10-year note fell 15 basis points from 161 down to like 144. That's 17 basis points. That's a move of 10%. Did the bond market figure this out? That all of a sudden, you know, the QE to infinity, Brainerd's coming in, you got the Fed put again. Dollar fell, gold rallied 60 some odd dollars over those 4 days. If I'm reading the tea leaves, we may get Lael Brainerd as the next head of the Fed. They came out, Politico reported Monday night that Biden's going to announce something before Thanksgiving here in the US, which is 2 weeks from now. What if that's what the bond market has sniffed out? What if that's what gold has sniffed out? And what if sometime in the next week or 10 days, it's announced, no more Powell. You're going to get this MMT loving, progressive loving, uber dove, Lael Brainerd as your next Fed chair. And then not only that, hey, one more. We've had Rosengren quit, Kaplan quit because of their insider trading woes. Quarles is another Fed governor that is retiring at the end of the year. Not only does Biden get to remake the Fed with this, you know, diversity hire of a middle-aged woman rather than just another old white guy appointed by Trump, he gets to name 3 other Fed governors. He gets to really remake the whole board of governors of the Fed over the next 6 months, 3 months. So that's something I don't think is really priced in yet, my friend, and something we got to be thinking about and watch real close in the days ahead.
What if gold has sniffed this out? What do you expect to happen over the next 6 to 12 months?
Yeah. So, well, and that's, I think, the time frame to look at it. You know, QE to infinity, which really is what it was, despite the fact they're going to try to start tapering this month. Remember, that was announced on March 23rd, Monday, March 23rd of last year, in the height of all the COVID stuff. And the week leading up to that, the dollar was spiking and gold was crashing and the stock market was crashing. Everybody was selling anything that was wasn't nailed down, I should say, you know, raising liquidity because, you know, we're heading into the lockdowns and everything else. 8 o'clock that morning, Eastern time, Monday, the 23rd, you get this announced, this alphabet soup of new credit facilities, 120 billion in QE, rates immediately cut to zero, all that stuff. Gold went up $100 that day, went up $100 the next day, leading to all sorts of problems within the global gold market. But we don't need, you know, that's ancient history now. But it didn't go from 1450, which it was at the close on March 20th. It didn't go from 1450 to 2080, which is almost a 50% move overnight. It went up traded sideways and kind of flagged out, for about 100 days in the spring and early summer of last year. And then boom, in the course of 8 weeks, went from 1680 to 2080, making a 50% move based on just what happened. Silver was even more dramatic. It didn't do jack really all the way into July, and then went from 18 to 29 in 3 weeks. So if let's put all this together, inflation continues, at its pace, and the Fed doesn't hike rates, but we should probably address that because that's all part of now what's getting talked about here today after the CPI. And you get Lael Brainerd, and all these dovish new Fed governors and stuff. Yeah, gold will go up, but it's not like it's just clear sailing. You're always going to have the usual forces in there trying to beat it back, manage the ascent. But you'll get this realization over time that inflation, stagflation is here to stay. Real interest rates, the Fed has to keep them negative. That's what they've done in the past with yield curve control. And gold will rally. And what's 50% from here? I mean, you get that same kind of rally that we got from March to August of last year. We get that same kind of move, November to, I don't know, next summer. What would that be? 1800 to 2600? I mean, you start bending about those numbers, people look at you crazy, but it's not unprecedented. So that'll be the thing to watch if all this stuff can come together.
So any comment on the rate hikes that are being discussed in the wake of the CPI report today?
Yeah, Justin, that's the thing. That's the fly in the ointment. That's what's washed us back today. I mean, gold earlier this morning got all the way to 1871, was up something like $40 on the day. And it's just been a steady wash back since. And what I don't want to say is priced in, because the only Fed speaker today was Mary Daly. And she came out and said, no, we're not moving forward our rate hike schedule. But you see it in the Fed funds futures. You see it in the two-year note. Two-year note yields up like 9 basis points today, up to 50. Okay. The dollar has soared. I mean, what's the dollar losing its purchasing power? Even they admit at least 6% a year, but the dollar soaring. Why? Because people think, well, look, the dollar's going to go up because interest rates here are going up. I mean, okay, fine. That's just how, the line of thought in the markets these days. But that's what's washed gold and silver back. And I did okay, so maybe that's your short-term risk, is that Goon Williams is going to talk on Friday, and maybe he says something like, yeah, you know what, I might be in favor of a rate hike as soon as March if the numbers, inflation keeps going like this. And all of a sudden the dollar spikes to 96 and gold gets washed back, to 1800 or something. That would be your short-term risk. And you saw, again, we've gone just today from 1871 back to 1853. That's a full 1% back down, as this narrative, this idea has taken hold, that inflation has gotten so hot so fast that now the Fed is going to hike 3 times next year instead of just 1 or 2. And again, even though Powell just said, no, not until 2023, and Daly just this morning was saying, no, nothing has changed. So that perception could still kind of hold us back in the short term. But again, the long term is what I've got to get right. Even if you're holding shares, I'm not one that trades, and tries to do all this stuff with it. If I get the long term right, then my mining portfolio is going to be okay. If I get the long term right, then I'll know when I should be adding physical metal to my portfolio. And I think the long term is what we're getting right here. The stagflation is here to stay. Heck, the third quarter US GDP was flat, 0%. Inflation's not going anywhere. None of this COVID stuff. We've been talking about this, like I said, for a year and a half. Excuse me. So I think long term we still have it right. We just now got to start picking off some important technical levels on the way up, so that it becomes obvious to some of these institutions and hedge funds that the bottom is in, and they want to play along, and you start getting some virtuous upside momentum.
How do you get the long-term right? What are you looking at on a day-to-day basis or a month-to-month, quarter-to-quarter basis?
Justin, that's the hard part about, being a gold person. If generalists just kind of, they just move from the hot sector to the next hot sector, and every market's just a dot on a screen, and they count waves and Fibonacci levels and stuff like that. But gold's a different animal, man. The physical market is run out of London. It's run by what we call bullion banks. They're responsible for flowing metal on a daily basis and managing all the order books from all around the world, sovereign orders, high net worth orders, institutional orders, all that kind of stuff. They have trading desks in New York that they work hand in glove with, trying to make sure price, doesn't get to a certain level that trips orders. Now they got to come up with physical. I mean, so just that part makes it unique. Then you throw on all of the factors that impact gold, moves the dollar, which is usually a headwind or a tailwind, moves in nominal interest rates, changes to not only Fed policy, but ECB policy, because if the ECB changes policy, that affects the euro. The euro makes up 57% of the dollar index. And so all of a sudden the dollar index moves and then the algos react. There's a geopolitical stuff we got to keep track of. What's going on in Ukraine? What's the likelihood of hot war someplace? What's going on in Iran? So all of these things is why 11 years of TF Metals report feels more like 25. But all that is what you got to get right if you're going to get the macro, right? The general trend. I thought I've had a pretty good handle on the general trend the last couple of years. We knew coming out of 2018 that the Fed had tried to tighten their balance sheet, and they kind of took that as far as they could, where they reduced, excuse me, my nose is awful itchy today. They drew down 750 billion in their balance sheet. They now added back on 5 trillion. So, okay. They let the 10-year note get to 3%, and all of a sudden the stock market started to collapse in December of 18. And that's when they knew they had to change policy. They formally changed policy from raising rates to cutting rates in June of 19. And that's when gold bottomed, finally at 1280, 1300, and then, went up more than 50% from there in the next 13 months. But this year, man, I thought, okay, I got a feel for this. I know where real rates are going there. I know the Fed has history of yield curve control. That I know that they have to have negative real rates if they're going to try to inflate away the debt. And so why isn't gold going to go, continue higher to 2300? I've been right about the macro, dead wrong about the price. But I think the macro stuff eventually is going to hold sway. And like I said, the institutions and the hedge funds that buy the gold in all its forms are going to be, catching on in greater and greater numbers in the weeks and, months ahead. So I think I've got the macro right. I'm not a deflationist. I think, they're going to try to run inflation as high as they can while keeping nominal rates in check, because again, that's about all the Fed can really do to keep the plate spinning. And so I think the direction is correct. What we need, though, to have happen in the precious metals, particularly gold, is to start picking off some of these price benchmarks so that more people get their eyes opened as to, that the downtrend is over. Because this year has been just steady progression of lower highs. And getting above 1836 finally here today on the 10th is the first kind of higher high that we've had. Now we got to hold that level. We got to hold that all the way through the end of the week, and we'll see if we can pull that off. But eventually we will. And then as you move higher and above 1860 and start to break out of the trend line that connects the earlier highs this year, and then as you move higher and finally pick off 1920, then everyone's going to go, okay, I'm late to the game. I got fear of missing out. Obviously, look at the double bottoms of the chart at 1680 and again at 1720. This bottom is in, get me in. And everybody rushes in at once. That's that kind of all at once part, like we saw back in the summer of 2020. But it's a series of steps. And as long as I've got the macro correct, then we will pick off those steps eventually. And that's kind of what I've been banking on all year.
Craig, there's so much stuff going on in the world right now, particularly, I would say, since March of 2020. What would you call, economically speaking, this time in the history of humanity?
Madness? Is that okay? Economic madness. I mean, we've got this monetary policy, okay? And I mean, maybe, just in our final minutes, I can spin this back and, and talk about the history. You're coming out of World War II, the whole world has been destroyed, right? Japan, Europe, all these manufacturing bases that are now present, were nothing. And the US, insulated by the oceans, and as a winner of the war, has all the gold, 25,000 metric tons. And so it's decided, if we're going to rebuild the world, we got to have a currency that people have confidence in, so you're able to transact, conduct trade and all that stuff. So the dollar, US dollar, was made the world's reserve currency, and it was backed with gold to give it confidence. Okay, so that worked 27 years. But then the world was rebuilt enough that some of those creditors that, France and Germany and Japan and everybody now has dollar stockpiles. And like, I think I'd rather have the gold. And since you'll give me an ounce for every 35 of these dollars, I think I'll take it. And eventually Nixon said, well, we can't do that anymore because we're now down to only 8,000 tons from our 25. We keep going, we're going to be at zero, like Canada. So they suspended that convertibility, and for the last 50 years the system just simply exists on confidence. Okay, the dollar, the euro, the yen, the pound, all of the currencies in this monetary system are backed with nothing but confidence. And so if confidence fails, when it fails, and this type of surging inflation is all part of what leads to a crisis of confidence. When it fails, what invariably happens is the pendulum swings all the back way over to the other side, and you've got to reestablish some type of sound money to regain confidence, get people to trade again. Okay, that's big picture kind of stuff. But that's ultimately, where we're getting to, and that's where I said, is it madness? Is it craziness? Well, yeah, because the system is based solely on confidence at this point. Confidence that my bank deposits are safe, confidence that I can get delivery of my gold contract, when I ask for it, that sort of thing. And so it's confidence that eventually is failing. And that's why I say that current system is madness, and it'll go on until it doesn't. It's just, good luck predicting when that day arrives, but it will arrive. And so in protection against that, everybody should at least have some part of your portfolio in physical gold and silver. Now, you can still trade all the stocks and everything else. I mean, there's opportunity cost, and no one wants to be 100% in anything. But man, to see yourself through the storm, that's what we talk about, for 11 years here at TF Metals Report, is having at least some physical metal in your hands. And I think that's always been a good idea. And man, nothing in the last 11 years has made that not a good idea. It's only made it more of a good idea as time has passed.
You've been watching StockPulse's Inside the Markets. We've had the honor and the privilege to sit down today and speak with Craig Hemke. He's the founder and publisher of TF Metals Report since 2010. Thank you so much, Craig, for joining us today.
Justin, it's been great fun. Great getting to know you. You guys do great work. And I hope we can do this again sometime.
And thank you, everyone, for listening.